The actual punchline of all of it is, no matter what we're doing here, all roads lead to inflation. Lynn Alden likes to say this, that nothing stops this train is the way she says it. She's got that great meme that she has. It's what I've been saying. It's the same thing Luke Groman's been saying, is all roads lead to inflation. And if somebody can come up with another way and show me how this would work without absolutely devastating the economy and then having the need for QE infinity, like multiples of the last time, I don't see a way to get away from inflation. It's going to happen, which is why I think it's so important to own assets and to keep yourself protected from it.
James Lavish, co-managing partner of the Bitcoin Opportunity Fund and author of the Informationist newsletter on Substack, and a friend of this show. It is so great to see you and great to welcome you back on. Thanks for taking the time to join us, James.
It's always good to be here, Julia. Thank you for having me.
We love having you on. And I got to say, we had you on this past summer and you were a huge hit with this audience. So I'm just thrilled to get you back on because I feel like, well, James, there's a lot happening. And let's start more with the big picture, where we always start with our guest. And that's more of that big picture, macro view, where we are today in the economy and the markets. And as you know, James, you can take all the time you need to set the table.
Well, I mean, if you've been paying attention to the markets, you know, we've been ripping to new highs almost daily. And a lot of that has to do with the election. You know, that uncertainty has been removed. You know, the economy has, it's been kind of clicking along. You do have some soft spots. We can talk about that. But, you know, by and large, it has appeared that, you know, that the Fed has engineered what they love to call a soft landing. You know, whether or not that is true, there's still a lot to kind of work through there. But just looking at the markets and looking at assets and looking at, you know, where people are investing their money, gold had a really hard run up before the election. There was so much uncertainty. And I mean, I own gold and it's been a great ballast for the portfolio for the last year and a half. And so, you know, particularly last year. But then once Trump was elected here, so much uncertainty about the market, about regulation has been removed. And now you've got the market kind of really leaning into that Trump trade, which is deregulation, you know, expansion of energy, deregulation of energy, you know, and so you've got the market that's it. I think it expects very much so that this administration is going to be market friendly. We know Trump loves to use that as a benchmark. He loves to point at the stock market and call the all-time highs and the best stock market ever. And you've never seen a stock market so good, you know, that stuff. And so, it's expected that he's going to put heavy pressure on the Treasury and the Fed to make sure that we have easy liquidity and that the market is able to continue to grow. And I think that's a big deal. The second side of it is, you know, you had the Fed leading into this election that has been concerned about inflation. And suddenly they started lowering rates. And so people were kind of confused about that. They're like, well, inflation's still above 2%. It's hanging around about 2.5%, 3%, depending on which measure you decide to use and which measure they decide to use each meeting. But then they cut 50 basis points. They cut another 25 basis points. And the bond market didn't like that. You saw that, you know, as they lowered Fed funds by 75 basis points, you saw the 10-year spike up by an equal or more, a larger amount in yield at the same time. And people are kind of frustrated. They're thinking, well, my mortgages, you know, I've wanted to sell my house or I want to buy a house and the mortgage is still high. Like, what is going on? And the answer is that people are concerned, investors are concerned that there will be a reignition of inflation like we saw back in the 70s and the 80s. And so, that the Fed may be making a policy mistake. Not that they've ever done that before, but, you know, they're concerned about that. And so the policy mistake would be that they would be lowering rates too early and allowing for that inflation to creep back in and flare back up. And the second side of that, that duration trade where the yields are going up on the longer end of the curve is that People are concerned, investors are concerned that there's going to be an absolute deluge of treasuries coming to market because of our just relentless deficit spending. And so they are concerned that even with the Doge Commission, the Department of Government Efficiency that Elon and Vivek are ahead of, there's just not that much they can do with it. And so they're concerned about that. That concern has eased a little bit, I think. And then just to kind of land this plane on where we are in the economy today is we've gotten a bunch of numbers this week on employment, unemployment, jobs created, job openings and all that. And today we've got a key number, which was the unemployment rate, and it ticked up ever so slightly. So it's kind of like this Goldilocks scenario that everybody's hoping for, that you get the unemployment rate ticking up, which is what the Fed is now focused on. So going back to what I was saying before, the Fed has been focused on inflation, but then these last two meetings, they've been focused on the unemployment rate because it did tick up a little bit, and they want to get ahead of it, in Powell's words, in order to make sure that we don't drive ourselves into a recession, which would be quite damaging for the market and for our economy. And so today's number that ticked up ever so slightly to 4.3% was like, wow, that's almost perfect for him to have just enough firepower to go ahead and lower rates again this meeting, but not so much that there's a panic, and there was enough. There's just enough softness in the labor market to give him that ammunition to go ahead and do that. And so that's kind of what you're seeing in the market. Market really likes it. The market has been pleased by this.
Yeah. What a great frame up to the conversation. So let me ask you this, because you did mention, while the market likes it, there are some soft spots. And I do think this audience would be curious, like, what are the soft spots that you're seeing out there?
Yeah, I mean, so, one of the things you keep hearing about is you're seeing that there's soft spots in the economy. Okay, so it's almost like there's two economies going on. It's the age old tale of the have and have nots, but it really has been playing out. And I'll give you a chart that you can put up on the screen that I posted just a couple of days ago that shows this. But when you look at the top 1%, I mean, the top 10% is ridiculous. The top 1% is absurd. The top 0.1% is even crazier versus the bottom 50% of asset holders in the nation. The expansion of that has been the separation of wealth has been absolutely astounding over the last 25 years, and it just keeps getting worse and worse. And over the course of the lockdowns, 2020, it really started in earnest after the first print back in the great financial crisis. But over the last, let's call it 15, 20 years, it's gotten pretty bad where that separation of wealth is great. So why does that matter? Well, it matters because as you had the Fed printing trillions and trillions and trillions of dollars, dumping that liquidity into the markets in the form of QE, buying outright bonds and mortgage-backed securities, and putting liquidity in the market, well, that has created this asset inflation. And so that asset inflation has been very beneficial to those who own the assets at the top end of that demographic. So you've got your, top 10 to top 1.1%. They've done exceedingly well. Who has not done well? Well, the lower demographic has not done well because that asset inflation has in turn also created inflation in the economy. And so, goods inflation. And so you have people out there who are in the lower demographic, wages they've not kept up and they lag. And so when you have inflation like this inflation has been lagging for so long, or the wage inflation has been lagging so long that most people in that lower demographic have been struggling. They can't pay for food. They can't pay for their clothes, the kids' clothes, the car payments. Insurance rates have gone up through the roof. A lot of people are just driving around without insurance anymore. It's been insane. And so you hear about, you hear about these people who are struggling and frustration about it, which was it was a big part of the election. That was a big focus for people in the elections. The economy has been terrible for a lot of people. For a few people, it's been fantastic. And that's the Cantillon effect, right? Where you've got whoever's closest to the money printer benefits from that. And if you own assets, you're benefiting from that. So you've got this older demographic, the boomers and people who own assets who have been sitting on a lot of cash that's in their money market account. They're making great returns on. They're making 4 or 5, 5.5% on it for years now. At the same time, their house has gone up in value. At the same time, their stock investments have gone up in value, and they're at all-time highs. And so they feel good. They're out spending. They're traveling. They're in restaurants. And then the other demographic is, oh my God, Chipotle's prices have doubled. I can't buy it for my whole family anymore. This is just insane. I can't afford my groceries. And so when you hear pundits, you hear economists, and you hear politicians say, oh, inflation's back down. Yeah, the prices are still rising, and they're rising at a slower rate, but they're still rising. And because that lower demographic, those prices eat up so much into their income. There's no discretionary income left over to make up for that. Whereas if you're a wealthy individual and groceries are 2 times what they were, a couple of years ago, okay, so it's an extra couple hundred, extra $300, $400, $500 a month for you. Not that big of a deal. It doesn't eat into that, your discretionary income that much. And so that's been what we're seeing. We're seeing kind of a tale of two economies. And so as the Fed has held rates very high here, it's created this situation that you've got deficit spending that's increased, which is inflationary, at the same time that you've got people who are sitting on these assets and who are making all this money in their money market accounts. They're able to spend that much more. And so it really has been a tale of two economies. And we're watching closely. I'm watching closely to see if that collides. And you talk to people like Danielle DiMartino Booth, who I saw last week. She's concerned. She's looking at the labor market. She's really concerned about that. She's looking at credit. She's really concerned about that. And I don't think she's wrong. It's just a question of how far can we get before that becomes a real problem, and can we get out of this before it does?
Yeah. We love Danielle on this show. Okay, so let me ask you this then. Can the Fed actually do anything meaningful here? Like what could be, like, can they actually serve Main Street truly? Like,
no, the problem is they've already made that policy mistake. That was the joke earlier in the show. They've made the policy mistake, and that was printing so much money. It's really hard to reel that in. So what can they do? If you can sort of engineer a landing here that avoids a washout of employment, like a huge swath of layoffs, then it may be okay because wages may catch up. But the reality is people are still falling behind because of asset inflation. And that's been the real big problem. And so what can the Fed do? Well, they've got 2 mandates, right? The first mandate is stable pricing, which is what they call the 2% inflation target. I mean, we've talked about this ad nauseum in other places. Maybe you and I talked about the last time, but the 2% inflation target is just nonsense. There's no even reason behind it. It's basically, and when Powell was asked about it on 60 Minutes, just at the beginning of this year, he was asked why 2%? What's magic about 2%? He gave some word salad answer that had to do with, the R star or the neutral rate. And he really couldn't even answer what it was. And because the reality is, and he's answered this before at other shows, it's what it's always been done. Actually, he answered, I think, in when he was testifying before Congress. And that's what it's always been done. That's what the world is generally accepted. Well, the world has generally accepted that, Julie, because it's what they can get away with. They can get away with that before people revolt and they start getting angry, like they did this last 2 years. 9%, 10% inflation is extremely painful. Okay. So that's their first mandate. They're declaring it all but conquered now by saying that inflation's down under 3%. It's going in the right direction. Okay. I agree. That's true. It is going in the right direction. It's still painful though. Inflation's never good. That's the first thing. The second thing is, full employment. That's their second mandate, which there's no even real measure for that. It's just, are we at full employment? How does it feel? Does it feel like we're in full employment? It feels kind of, it's not too bad. So, so they're looking at the unemployment rate, and really what they're looking at is just avoid having a spike in the unemployment rate. Now, the measure that they've been looking at very closely for a number of years now is the Sahm rule. And Claudia Sahm was a Fed official years ago. I think it was before she went to work for the Brookings Institute. And she came up with this measure. I won't go into too much of the math of it, but the simple explanation is that if the unemployment rate rises more than 0.5% above where it bottomed out over the last year, then you're in a recession. And every time that has happened, and it has risen up to that level, then you see the unemployment rate just spike from that point up, and we're actually already technically in a recession. We've been hovering right at that level now for months. And so the Fed has been very attentive to that. Okay. So that's their second lever. That's the second, mandate. So what are the levers they have? Well, they've got interest rates that they can move up or down. And the target rate, which is really just the short end of the curve. They don't have control of the long end of the curve, as we learned, pretty viciously this last 6 weeks. But they can move that cost of capital at the short end of the curve up or down. If they move rates up, it makes it costly for people to borrow money. It slows the economy down, people and companies. If they lower rates, then it makes the capital easier to get, cheaper to get, and it stimulates the economy. The second thing they can do is now this new kind of thing that's come along in the last 15, 17 years is QE, which is QE or QT. And that's quantitative easing or quantitative tightening. It's literally the Fed and the Treasury team up, they print money, and they go into the market and they dump liquidity into the market, or they draw it out. And that's by they either are buying bonds, which are treasuries or mortgage backs in the market, or they're selling them. If they're buying them, that puts dollars into the market. If they're selling them, that's taking dollars out of the market. And right now they've been doing QT. They were doing $60 billion a month earlier this year. They stopped. They cut that down to $25 billion a month, which in reality is not that much money. $25 billion a month. We're talking about $300 billion a year. I mean, that you're not really reducing that balance sheet by that much off the Fed balance sheet. So that's not really impacting the economy that much. The bigger thing would be it would be a huge indicator if they stopped QT altogether and they stopped selling those $25 billion per month. That would be a huge indicator that they're really concerned about liquidity. And we can get into why they would want to do that. And then the second thing is they could turn around and on a full pivot, now they're lowering rates, and the full pivot would be now they're also instituting QE, where they're pushing liquidity into the market again.
Okay.
All my 20-minute answers.
You know what? The record is 22 minutes and 30 seconds. So, which, what the audience doesn't mind. They love it. I do want to ask you, just because earlier I wrote this down too when we were just talking about like what's been happening like in the bond market and with yields. And you were talking about this deluge of treasuries coming to the market. And we still have this relentless deficit spending. And even with the Department of Government Efficiency, I want to hear more on that bit, because this is something you've written about a lot. Like, we have a massive debt and deficit problem here. So just curious, want to hear your big picture and maybe your thoughts on Doge, and can they move the needle at all?
Well, I mean, so some of your listeners have already heard me talk about this, about the debt spiral. I wrote on, this is one of my first threads I ever wrote on Twitter before it was X. And it was 2 years ago that I wrote about it. And I believe at the time, the debt, in fact, I will even look it up here because it is so insane. The number has grown so much. But I wrote about the debt spiral and, in simple terms, it's just that the government is spending so much money that they are creating this deficit that creates a need to borrow more. You can't even cover the amount that you're borrowing with your tax base. And so you have to borrow more just to pay off the maturity of old bonds. So you literally you're in what's called a debt spiral. And so, so when I wrote about it on August 23rd, 2022, I just brought up my tweet. The deficit, the total debt, was 30.7 trillion.
Oh,
it's
wow.
now 36 trillion just 2 years later.
Oh my gosh. It's, even more than that. Yeah. 36.1 something. I was looking at the clock just now.
Yeah. And so that's
$6 trillion.
$6 trillion. And so that's the debt spiral. So what's happening is that, if the line is that if the U.S. government was a company on the New York Stock Exchange, I know it's not because they can print their own money, but if they were, they'd be considered a zombie company. And why is that? It's because they don't have enough earnings after their mandatory payments. So they don't have enough net earnings to pay for the interest on their debt. They have to borrow more money just to pay the interest on their debt because they spend so much. And so let's talk about Doge. This is really exciting for some people to think, oh yeah, they're going to cut out all the fat. Musk and Vivek are going to come in. They're going to cut the federal spending. Musk said we're going to cut it by $2 trillion annually. And that's not realistic unless you're going to cut into Social Security, Medicare, Medicaid, because they make up such a large amount of our spending that you just can't get there. I mean, if you look at Medicare and Medicaid, that's 1.8 trillion. Plus you've got your social services, Social Security and other programs, which is another 2.5 trillion. So right there, you're already at 4.3 trillion, right? And then, just on those two items. And then you add your interest and you're at 5.1 trillion because the net interest on your debt is $800 billion. So now you're already at 5.1 trillion. Well, the problem is we only took in $4.9 trillion last year in tax receipts, but that doesn't even account your defense spending, which is kind of mandatory in this day and age. How much you need to spend. That's a huge debate. I'm not going to get into that. I'm not a warmonger. I don't think we should be involved in every single freaking war around the world. That's just insanity. But that's $870 billion right now. And then you've got your other discretionary expenses, which are $750 billion. So if you look at all of those expenses, those are signed into law, the Medicare, Medicaid, and Social Securities, right? And then you get your net interest on your debt. Well, you've got to pay that because if you don't pay that, well, you default on it. So that's mandatory. Right? Defense spending is not mandatory, but who's going to cut it? That's not going to get cut. But where are you going to cut? You've got $750 billion of discretionary spending. If you cut all other spending, everything, all other spending in the government, you're only going to save $750 billion. How's that going to work? Like, how are you going to do that? So that's cute. And I think Elon is, he's clearly one of the most brilliant minds of our generation, if not the most brilliant mind. Right. So, but you're not going to get to $2 billion of spending cuts. Okay. So then you had them write just last week, they wrote, or maybe it was a week before, Musk and Vivek wrote an op-ed in the Wall Street Journal. They said, we're going to cut federal spending by $500 billion a year. Okay. So $500 billion over 4 years, that equates to $2 billion. Okay. So maybe that was the clarification.
Wait, 2 trillion, right?
2 trillion. Yeah. Sorry. Yeah. Did I say billion?
Yeah. All good. Yeah. 2 trillion.
Yeah. So $2 trillion. So they're big numbers. I get confused sometimes. Okay. So if you do that, that's great. But they're talking about reducing the federal agencies from 400 to 100. So you're going to cut federal agencies by 75%. Okay, there's going to be some pushback on that, I believe, because there's a lot of pork in there, and there's a lot of politicians who are eating out of that barrel. So I don't know how they do it, but hey, if you can cut 75% of the workforce, that's great, because if you do the math on that, Julia, that's like reducing the federal headcount by about 1.7 million employees.
Yeah. Well, that would probably that would push up the unemployment for sure.
That will, but the productivity that comes out of the government, it's not that
That
great.
is that is true. Yeah.
It's just a lot of red tape. It's a lot of regulation. It's a lot of just, paper pushers and administration. To be truthful, it's a lot of that. And so, but if let's just say that you reduce it by 1.7 million employees, and the average is somewhere around $140,000-$150,000 per year, you're talking about saving about $250 billion a year.
Okay.
That's still only 250 though.
Yeah.
I mean, we sent that to Ukraine like yesterday or something, right?
Yeah.
So I mean, like, not really. That's facetious, but that's what we're looking at. So where are you going to find the other 250? Okay, I bet you there's a lot of pork in there you can find. There's fat that you can cut to get to 500, but for illustrative purposes, it's not going to be easy, and they're going to have a battle. Do I think they can do it? Possibly. Do I think they can balance the budget? No, I don't think they're going to balance the budget. And the reason is that interest expense is so high that even when the Fed does lower rates, which will help, the Fed lowering rates will definitely ease the burden on the Treasury to keep issuing more and more T-bills in order to make up that difference. It will help. The interest costs will come down eventually. It's going to take years, but it will. But it's not going to come down to 100 billion. So what do you need to do? Okay. Well, now you got to go to the other side of the equation. So the Doge is great. That's all great. But the other side of the equation is productivity. The problem that we're having, Julie, is that every dollar that we spend right now on the deficit is returning a smaller unit, fewer units of productivity for every dollar we borrow. That's the problem. So we're borrowing money and we're borrowing more and more money, and the productivity that we're getting out of that is not rising at the same rate. And so we need that to change. How do you change that? Well, that's why investors and some economists and who are don't have party affiliation and a lot of businessmen are excited because they see they've got this administration that's going to come in and they're going to cut regulations. They're going to cut red tape. They're going to open up, drilling. It's going to be good for small businesses. They're going to probably lower taxes or give tax breaks or incentives to businesses. And that just increases margins, right? So it increases margins for companies, especially small companies, which are the engine of this country, arguably. And that will then increase some of that productivity, real productivity, not fake productivity, which is created by printing money. But they'll do that too, right? So we'll have some inflation still, asset inflation still. We'll get higher tax receipts and GDP nominally up, but then we'll get, hopefully, the hope is that you get real productivity up. And that way, when you're taxing those dollars on real productivity, then you're able to start lowering that deficit a little bit and hopefully getting it down. How much they can do remains to be seen. How much they can push through and changing regulations and removing regulations and red tape and strangling small businesses. Well, that remains to be seen. It should be a net positive, in my opinion. We'll see.
Okay. So as of right now, though, the current trajectory, we're headed toward the debt spiral, but I hope they're successful. I hope they can make something work. I'm glad someone's actually going to try.
At least more productivity.
Yeah.
We could have a productivity miracle, through AI and all that, but you're still talking about this. This is a major gap. We've never had debt to GDP this high, in the modern era. We're like 124, 125% debt to GDP. I mean, we have a problem. And so the bottom line is, and the actual punchline of all of it is, Julia, is that no matter what we're doing here, no matter how we get there, all roads lead to inflation. And, Lynn Alden likes to say this, that nothing stops this train, is the way she says it. She's got that great meme that she has, but it's what I've been saying. It's the same thing Luke Groman's been saying, is all roads lead to inflation, period. I don't see another way. And if somebody can come up with another way and show me how this would work without absolutely devastating the economy and then having the need for a like massive QE, like we're talking about, QE infinity, like multiples of the last time, which would happen if we drove the economy into the ground because we're so financialized. I don't see a way out. I don't see a way to get away from inflation. It's going to happen, which is why I think it's so important to own assets and to keep yourself protected from it.
Okay. By the way, we have Luke Groman coming on in 2 weeks, so just plugging that for the folks. All right, but if all roads lead to inflation, Bitcoin. We have to talk about Bitcoin. And for folks watching and listening, we are recording this Friday afternoon. The market's already closed. So Bitcoin never closes, but Bitcoin is currently it's above 100,000. So let's hear more of your thoughts on Bitcoin. You've been in this space for a long time. You have the Bitcoin Opportunity Fund. Want to hear just more, and how important too was that 100,000 milestone? I suppose, maybe psychologically even.
Yeah, no, psychologically has been a huge milestone. We can talk about that. The Bitcoin has been important to me and to a lot of people that I work with, my colleagues around. All the people we've talked about already. Why is Bitcoin important, and why is it such a good gauge of what's going on with inflation? Well, if you look at Bitcoin and you plot it against the money supply, and Michael Howell's got this great newsletter that
we love him too.
Yeah, he does a great job of. I really like the way he looks at liquidity, and he has a great gauge. It's a proprietary. I don't know exactly how he does it, but it seems to be very good. And so he looks at not just dollars that are being created by each country and adding them all up, which is a typical way. He also includes some of the leverage, some of the debt leverage, some of the volatility, which affects liquidity. And so, but when you look at that and you plot Bitcoin on a 3-month lag to that, so money supply chart, 3-month lag to then the Bitcoin kind of lags it. It almost moves lockstep. It's been a very good gauge at the expansion of the money supply. So why is that important? Because the expansion of the money supply is really our best gauge at what is happening with inflation. So inflation really does occur, especially asset inflation, from the expansion of money supply. And so Bitcoin has been able to, even though it's volatile. I mean, I hear the argument over and over and over again that it's volatile. I know, I get it. It is volatile. I do understand that. But the volatility in a rising asset is a good thing. It gives you opportunity to take advantage of those swings in price and add to your position in it while you're trying to build your position and protect yourself from that long-term inflation. It is a long-term asset. It's not something you buy and sell within, just a couple of months. You can day trade it. There are a lot of people who do that, but the real benefit from Bitcoin is buying it and holding it for a 4-year period or longer. And nobody's lost money in a 4-year period of holding Bitcoin. And so it's really important as a gauge for an inflation, and especially inflation of the money supply. So what's been going on? Well, you've got a lot of things that have happened this year, right? You've had which have been great catalysts, and there are new catalysts that are coming, and they're not fully priced in, but they're not being ignored anymore. And this is really important. So the big first catalyst was the ETFs. The ETFs made it super, super simple for institutions, family offices, small pension funds, small endowments to come in and start buying Bitcoin and putting it on their balance sheet as a separate asset class without having to do anything different. Before it was so difficult to get it in their portfolio. Even if they loved it, they had so many operational hurdles to it. Like, where do you buy it? What exchange do you buy it on? Who's going to actually execute that order? Because we don't have traders that do that in institutions. How's it going to settle? Where are you sending money to? Are you really going to send money to something called Kraken? Like, what are we doing? Who's going to hold the keys? Like, all that stuff. There was operational headache that you just couldn't get through. You couldn't get over. So, but with the ETFs, in one fell swoop, they took care of all of that, where you just go to your broker that you've been using before. You go to Fidelity, you buy the ETF, or you go to, you buy the BlackRock ETF right off the New York Stock Exchange. You put it in your portfolio, you settle it DTC just like any other stock. And, that there's Bitcoin that's backing that ETF in that digital physical form. And you know that it can be audited and you can see it on chain that they own it. So that's been an enormous, positive for Bitcoin in particular and in this space. And if you look at it, Julia, Bitcoin's the BlackRock ETF, IBIT, was the fastest growing ETF in history. And I'm looking at my notes here. It got to $40 billion 6 times faster than the previous 3 fastest. It's now in the top 1% of all ETFs in size. And just under a year old, it's bigger than any ETF launched in the last 10 years. This has been an extraordinary launch. It's been incredible. So that's a really big deal. Well, the second thing that's happened is just recently is now you have options in ETFs. Well, that gives other institutions the ability to hedge risk on it, and manage their risk management around it. They can manage liquidity around it, especially proprietary books can do it. Family offices can do it. Hedge funds can do it. It's been a big development to get options on it. And it just further solidifies that this is a real asset class. The third thing that's happened is you had the FASB accounting rule. So now you've got this accounting rule that it used to be if you bought Bitcoin you're a company and you put it in your treasury, right? Like MicroStrategy. We can talk about that in a second too. But when you put it in your treasury, right? If Bitcoin went down, you had to take the worst price of what your purchase price was or the lowest price it went to. And it was held on your balance sheet as an impaired asset. That's the way it used to be. Now, starting this month, anybody who's in the fiscal year December or starting next year, all companies can now buy it, and now they're marking it to market. So you don't have to take it as an impaired asset anymore and carry this impaired asset on your balance sheet that just destroys your ratios. So that's a really big deal that people are not really thinking about. That's going to be helpful for companies who want to hold it on their balance sheet. That's another thing. Then you get this other thing. It's kind of hanging out there now. And we talked about Trump and and this favorable administration. Well, this administration has been extremely favorable compared to the last one. The last one's been vicious. It's been absolutely brutal. I've felt the pain from Choke Point 2.0 with my hedge fund. They have been attacking Bitcoin and cryptocurrency companies for years now, and it's been brutal. And so they're out. They're no longer going to be in charge. Gensler's out. You've got new SEC chair. You're going to have new banking oversight committees. And so it's different. Well, now that what's hanging out there is the Bitcoin Act. And this is spearheaded by Senator Lummis, Cynthia Lummis, who's from Wyoming. And she wants to create a Bitcoin reserve. And so what she's trying to get passed is an act that will have the U.S. government buy 1 million Bitcoin over the next 5 years, which is 200,000 Bitcoin per year, and then hold it in U.S. Treasury as an asset. So, I mean, that's a big deal. So that creates something that is kind of game theory for other countries. Now, if the U.S. is going to buy Bitcoin and put it on their balance sheet, well, heck, I better put it on my balance sheet. If I'm Japan or if I'm Russia, if I'm China, I'm Brazil, talk about all the BRICS countries, Brazil, Russia, India, China, South Africa, Saudi Arabia.
With such a limited supply too.
And such a limited supply. So that's a really big deal too. So you have all those catalysts kind of happening at the same time. So after the election, Bitcoin had been consolidating for a long time, for months, in this range of 45 to 65,000, just kind of consolidating in that range for so long. And then after the election, you get a few weeks after, and boom, it takes off. It breaks through, and now there's been it's blue sky from that 70,000 level to 100, and so now we've been bumping around right about 95, 100 for the last couple of weeks. And so, and that's been also a pretty big deal. And that's giving confidence to people that, okay, this is a real asset class. And it can't be ignored anymore because of what you said at the beginning of that question, which is that 100,000 level is just such a mental level. I'll tell you that when I started looking at Bitcoin for the second time, I ignored it the first time and I did ignore it the second time. I had this gut sense. I said, Bitcoin was trading around $3,500. I said, this thing's going to be $100,000 one day. I just know it. You can just see it. I got warded off it by traditional investors, analysts and tech analysts and portfolio managers in traditional investing space. They told me it was a Ponzi scheme. That was crazy. So I ignored it. It was the biggest mistake in my investing life. But here we are. We're at $100,000. All the naysayers who have been saying that it's just a Ponzi, it's a tulip, it's it's some sort of scheme that everybody's going to lose all their money in. I mean, you can't deny that this thing is just continuing to grow. The ecosystem is growing, and there's a lot of excitement about it. And so the $100,000 level it's a really big mental spot. And today, if we close here, this would be the first time it ever closes over $100,000. And right now, it's right over it. We're close. I think it'll happen in the next, whether today or the next few weeks, it'll happen, and then it'll kind of hold that level, barring some sort of economic downturn or some sort of black swan event. I think that I'm super excited about it. Our hedge fund, we've been invested in this for a little over a year now, and this has been a great space. It's a super exciting space.
Yeah. Okay. So when you first got in, that second time looking at it, it was around 3,500. You thought it could be worth 100K. Obviously, here we are today. Where do you see it headed? And I don't know if you're comfortable going there or if you have like price targets or where do you see it headed, but have you kind of ever thought through that, where it could go? What's the trajectory in your mind?
Higher.
Like how much higher?
So I really don't love price targets, but
okay.
But I would say I would be very surprised if this is not up between 50 and 100% this next year. And the reason for that is that all of the catalysts I just talked about, and once when it holds this $100,000 level, it just continues to become this asset that allows for the institutions to come into and come out of it with ease. Now we bump up a true $2 trillion asset, and we're in the top 10 assets in the world. Like this is just, it's incredible how much this thing has grown. And so what I believe is going to happen this year is that it's going to continue to be taken seriously, and that it's going to continue to be seen as a separate asset class. And that understanding, this is the key. The key is the understanding from the institutional world to understand why it's different. And as investors understand that, they're going to allocate to it uniquely, differently. They're going to take a portion of their book and allocate to it. And so when you start getting, the fact of the matter is, Julie, is that the Bitcoin currently is just under 2%. Just under a $2 trillion asset, right? And, it's 1/10 the size of gold. So you'd say, yeah, but it's only 1/10 the size of the gold. Yeah, but it's 1/10 the size of gold in 15 years. Gold's been around for thousands of years, and this is a new store of value. You're starting to hear people on television shows, on mainstream media, which is interesting. You're starting to hear people say, well, this is a store of value. It's a store of value. It's a store of value. And so people are hearing digital gold. And so when you have $900 trillion of global investable assets, and Bitcoin is just 0.2% of that, it's got a long way to go. If it just becomes 1% of total assets, of those investable assets, it's $450,000 per coin. So that's where we're headed. Whether or not we get to 200,000 this year or next year, not 2025, but in 26 or 27, I see it going much higher. And because of that demand, and demand to own it in people's portfolios as this pristine store of value.
Got it. Well, we are at time. I've taken way too much of your time. Do you have time for one more question, or you have to go?
I do, yeah.
Okay. I wanted to ask you this because I think you want to talk about it too. And you kept on mentioning MicroStrategy and Michael Saylor. And I think you've actually kind of looked at how does MicroStrategy actually work in terms of its Bitcoin strategy? Would love to just hear more there because I frankly, I don't know. So I kind of sensed that you wanted to talk about it.
Oh no! It's one of our biggest positions. Been one of our biggest positions in the hedge fund. So let me first disclose that.
Okay.
We do own it, but I know Michael. I've talked to him a number of times. I talked to Sharish, one of the masterminds behind this whole strategy, and it's brilliant, right? So Michael has found a way, and he likes to put it in this way. He doesn't like the term money glitch, which I learned recently. But he likes to put it in the way that he's found a way to create Bitcoin yield for his investors in his stock. And so what he means by that, in my interpretation of it, is that you buy a stock and you hold it and you're going to get more Bitcoin per share as, in the life of holding that stock. And so that's what's exciting to him. Okay. So when you look at MicroStrategy stock, it's trading. If you take all the shares and you multiply them out, and then you take all the underlying Bitcoin and you get to that value. Well, the shares are trading at somewhere around 1.7 to 1.8 times that underlying value of the Bitcoin. It's getting a multiple premium, right? And the reason for that is because Michael's doing a few things here, right? So the first thing he's doing is he's borrowing money through convertible bonds, and he borrows money, issues these converts, and then takes that capital he gets for that and buys Bitcoin with it. So, but the key here is that he's buying that Bitcoin and attaching that underlying Bitcoin value to his stock. It makes his stock volatile. So typically when your stock is volatile, it's often because you're just a high flying tech, or you have illiquidity in your stock. But for him, for MicroStrategy, it's volatile because the underlying asset that it anchored to is volatile, which is Bitcoin. So, but that's good for the convertible bond buyers. Why is that? Because, Bitcoin is volatile, but as we said earlier in the show, it's volatile to the upside, right? And so because of that, this gives optionality to the buyers. It's convertible into stock. So that optionality is that they can trade around it. They can short some MicroStrategy around it and trade around. It's called delta hedging, and trade around that amount that they're delta hedged because of the volatility of the stock. That's one thing they can do. But really the second thing they do is they can eventually convert that bond into common stock, and they'll get common stock for it at a premium. So they're able to do that. The stock will go through the strike price of that convert, and they're able to convert at a great gain. And so you're seeing those converts are all trading above where they were sold because of this. And because of that optionality, that value that they're getting by buying that optionality, he's able to borrow at near 0% financing. So the last bond that he just issued was $3 billion, and it was at 0% yield. So the interest rate on that was 0% because he had a 55% premium to the stock price on the convert. And so, that created this ability to borrow that money pretty much for free. And so he's borrowed $7.2 trillion at less than 0.8%. It's well under 1% that he's borrowing that for. So his underlying business of his software business that he runs in MicroStrategy is paying for those bonds, no problem. And so this is the amazing thing he's found. So as he borrows money, he buys Bitcoin, his shareholders get more Bitcoin. So the second thing that it creates, Julie, is that because of that, his stock is trading at a premium to the underlying Bitcoin because people expect to get more Bitcoin, right, as they hold stock in the future. Well, because of that, he's able to use something called the ATM at the market. The ATM is he goes to the ATM and he issues shares and he gets money, basically, right? So he goes into the market and he sells shares at the market. He gets money and he turns around and he buys Bitcoin with it. Now, normally, when you issue shares, you're diluting underlying shareholders, and so it's usually a dilutive transaction where unless you can immediately, very quickly create value for your shareholders, then the stock price will go down because there are more shares for the same amount of value, same amount of earnings. But in his case, he's taking that money, he's turning around and buying Bitcoin with it. And so the shares actually go up because they're attached to the underlying Bitcoin. They go up by 1.5, 2.5 times the amount that he borrowed. So if he borrows $100 million, goes and buys $100 million of Bitcoin, then he announces that transaction that he did that, and the stock goes up by $150 or $200 million. So it becomes accretive to his shareholders. It's kind of mind blowing, but that's what's been happening. And that's why it's been a great stock to own for the last, this last year.
Wow. It's kind of funny. Like, I don't even know what MicroStrategy does, to be honest, other than I just know them for Bitcoin.
They're enterprise software. Yeah.
Yeah. And well, I think this is what kind of like, or at least for me, that's what the Bitcoin play was, what put them on the map. Do you think we'll see other companies add it to the balance sheet? What was it? A couple of years ago, Tesla did briefly.
Yeah, you've got Semler Scientific is doing it. You've got Dylan LeClaire is involved with Metaplanet, which is out in Japan. It's doing it. But as far as the US, there are a few companies that are doing it, that they're trying to do it. You saw Marathon is doing it. It's obvious for them to do it. They're issuing converts and they're buying Bitcoin for their balance sheet. They're doing the same thing. They're trying to run that playbook. I do expect more companies to do this. You've got Microsoft has, it's on their proxy for the December 13th vote next week, where they, it's on the proxy for them to buy Bitcoin for the treasury. It's going to the shareholder vote. I don't think it's going to pass. The reason it's not going to pass is because the board of directors advised against it. So you had one small shareholder who pushed to have this put on the proxy. They agreed, reluctantly, clearly said, we don't advise, we advise a no vote on this, vote against it. So what happens in this, and this, is that you have the proxy firms that these institutions use that they advise you, because you have too many proxies to vote. You're voting proxies every day, pretty much, if you own, thousands of shares of companies. So
most people probably don't vote. Yeah.
Yeah. And so they pretty much do it on your behalf,
Yeah. Like the institutions.
Yeah. Right. And so, and they'll typically, 97% of the time or something, go along with whatever the board of directors tells them to. The board recommends against or for, we're going to vote with the board. The only time they don't do that is when there's some sort of contentious proxy battle or some sort of merger, or, somebody's coming in to, as a hostile aggressor. So, but, I don't see them doing it. And then the second indication is that Michael offered his time. He offered to come present to the Microsoft board of directors and tell them about Bitcoin so they could understand it before the vote. And they said, "Oh yeah, sure. We'll give you 3 minutes." So they gave him 3 minutes, and his answer was, "Okay, here's 44 slides. We'll go through them in 3 minutes.
Oh my God.
Now it's up to you to learn what's in this slide deck." It was just offensive. It was absurd. This is a guy who's made tens of billions of dollars over the little over a year and a half or 2 years, and they're laughing at him. So, do I think it'll happen? No, not for Microsoft, not December 13th. Do I think it will happen next year for another company? Yes, I do think that another company will wake up and say, you know what? We should be utilizing this strategy, because as we sit here and inflation continues to rage on, every single dollar we're holding on to in our treasury is melting. And even if we hold treasuries, anything longer than a T-bill is, and even the T-bills at this, are often in real inflation terms, they're returning a negative real rate of return. So you're losing money on that trade.
Yeah. Well, James, I have to say, we love having you on the show. You're always welcome on. We got to get you on more often, maybe do a little bit more of a check-in with you. I want to give you the final few moments here. Let folks know where they can, find you on social, read more of your work, your amazing newsletter, The Informationist, anything that you can share about your firm if you'd like, and any parting thoughts, anything that you'd like to leave this audience to think about. The floor is all yours.
Thank you, Julia. I appreciate you having me on. I like being here. So, I have the Bitcoin Opportunity Fund is the hedge fund I run with David Foley, and David Foley and I have been working on that for a little over the last year. And I can't really talk about returns on a show like this, but we've done very well, and we're excited about the opportunities there. That fund is closed. We're not accepting investors for that fund, but we've gotten not surprisingly, a lot of people who have been asking about investing with us. And so we're working on creating a second fund. So for anybody who is interested in that, and if you're an accredited investor, you can just go to bitcoinopportunity.fund, www.bitcoinopportunity.fund, and just put in your name and attest that you're accredited, and we can send you information. It's not my rule; it's the SEC's rule. There's nothing I can do about it. But and so that's that. And we're seeing great opportunity. We're super excited about it. I'm super excited about the Bitcoin space, the part of the cycle that we're in, the kinds of companies we're seeing, the kinds of opportunities we're seeing. Super excited about. I'm especially excited about this next few years. And so I remain super excited about it. Now, that said, one of the parting thoughts is that I'm a long-term investor in this. I don't expect to make, hundreds of % returns in months, not like meme coins or some of the other cryptocurrencies. This is a long-term investment, and and we see it as in long term, it's stable, and and that volatility doesn't bother us, because over the long term, it's beneficial. So, and then finally, I write that newsletter, The Informationist, which you can find on Substack. And I just take one financial topic that's kind of confusing or complex, and I simplify it for anybody every single Sunday morning. So.
Well, you love it. James Lavish, co-managing partner of the Bitcoin Opportunity Fund and author of The Informationist, available on Substack. Thanks again for being so generous with your time, all of your ideas, your knowledge. We really appreciate you and look forward to having you back on. Take care.
Awesome. Thank you for having me, Julia. See you next time.